It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Here at the beginning of the year, it's not too early to start setting yourself up to be even more favorable with your tax position here in 2025. Proactive tax planning at the start of a year can help reduce how much you pay in taxes throughout the year. So we're going to share 5 ideas for you to be considering and planning this year. That and more on today's episode.
That's right. And tax planning, we're talking about that. That's sort of the main thrust of the show. And you could say, well, wait a second, there's still an opportunity to improve last year. Oh, absolutely. And take advantage of that, work with your CFP. But here, when there's so much of the year ahead of us, 11 and a half months, what things can you do right now to put yourself in a great position? That's what we're helping with. If you have a question for the program and would like to reach out, you can do so in a few different ways. Call or text us, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can find us. And then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. All right, tax planning. This is something we're passionate about. And, there used to be a time, I think, and for some financial advisors, the time is still right now, where you go and ask your financial professional, let's call them an investment advisor, hey, how does this impact my taxes or whatever? And they say, talk to a tax advisor. Mm-hmm. They're treated as separate. Yeah. Guys, they are not separate. They're not separate. In fact, tax planning, not tax preparation, tax planning is one of the 6 areas of your financial life. And these aren't separate and distinct areas. You've got to look at how the decisions you make impact these seemingly disconnected parts of your financial life to make wise decisions.
Yeah, there should be a theme. If you look at your tax situation, I would encourage you to be able to answer the question, how is my tax situation optimized, and what are the strategies I'm taking advantage of? And just this last week, we were talking with a Wise Money Show listener down in Indianapolis, and they had investments kind of all over the place. And I asked them, well, who helps you with your tax planning? And really quickly they said, our accountant does. And I said, that's excellent. And then we got going, and I said, well, you've got investment accounts at 3 or 4 different locations here. Do they all talk to your accountant and come up with a strategy for how to optimize your tax situation? And they said, no, none of them talk to our accountant. And I said, well, so who is that on? Is that on them or their account or your accountant? And they said, well, okay, well, our accountant doesn't really help us with, he does our taxes. Yeah. And so it doesn't make their accountant a bad person, but you want to make sure that you're aware if there's tax preparation happening, there's also tax planning happening. And to Mike's point, it's likely going to be a certified financial planner who's helping you with that.
Yeah, that's right. And it may seem early to even be thinking about tax planning for 2025. Often you've heard us say over the years that right as you're preparing last year's taxes, immediately begin pivoting and thinking about the year ahead. Well, most people listening today, if you're listening at the time this airs, then you recognize, well, my taxes aren't even done for 2024. So you want me already thinking about 2025? And the answer is yes. But public service announcement here. It's not too early to be thinking about how do I finalize the tax planning process that I did last year as I prepare my 2024 returns, because it really does provide another snapshot of what you're experiencing in your tax picture. Anytime you're dialing into or focusing on your tax picture, there's some new wisdom, some new perspective that you can be gained. And being proactive in that and being fully engaged in it with your certified financial planner sets you up for not just a great year ahead, but maybe a better tax picture over a lifetime.
That's right. So also start collecting your documents for 2024. If you don't have a plan or even an appointment set to get your taxes done, or however you do that here, we have folks that, collect all their documents, drop them off, schedule a meeting or have a meeting already on the books with their CFP the return's done, and then we sit down with the draft of the return to talk through accuracy, but also additional planning opportunities. One other public service announcement. One of the trends with some tax documents come in paper, some are email, some you've got to go retrieve. It has just led to an overall kind of you might feel disorganized with that because you've got forms coming all over the place and I don't know what I got. I would say work on that organization. Make sure you've got everything before you provide it. Tax costs have gone up and they continue to go up, and that's something that you can do to help make things a little bit easier for your tax preparing team and your CPA.
Man, that's never been more important because there's a shortage of tax preparers out there.
Yeah.
More and more people are retiring out of that industry. There are the smallest number of graduates coming out of accounting majors and programs and things. So if the back door of that industry is wide open and the front door seems to be mostly closed, there's going to be a shortage of preparers. And here's what that means for you. If you are settling for just tax preparation, your tax preparer is going to be stretched even more thin than ever, potentially, and you may get swept along into just getting the right numbers in the right boxes and hopefully having an accurate return. And the likelihood of proactive advice coming from just someone who's just a tax preparer, if it was ever there to begin with, it's getting more and more rare. And that's why we talk about certified financial planners being the bridge that helps you connect all of these areas of your financial life, including your tax picture.
Those forces are at work.
For sure.
And you might say, oh, yeah, but at least if the tax advice is stable, then yeah, maybe it's a little harder to receive. No, guys, the tax advice that's needed is significantly higher than it used to be. Thanks to Secure Act 1.0, Secure Act 2.0, the changing tax laws, you have no idea. That's actually part of the reason why a lot of experienced CPAs are getting out of the business, is because every single year there's enormous tax law changes, and it's just making the job harder. So anyway, let's get into planning. Let's get into because
this is a show about financial planning.
That's right. So 2025, the year ahead, okay, is going to be unique because of these changing tax laws that many of them are starting to become, put in place, become active. But also, we're going to find out at the end of the year, or hopefully sooner than that, whether tax rates are going to sunset at the end of this year. And so this is an interesting year, and definitely a year you want to be proactive with your tax picture. Now, sometimes being proactive with your tax picture means, I've got high income this year. How can I get more deductions? How can I reduce my tax bill? Other times, I want to do a Roth conversion. I'm in a low tax bracket this year. Let's invite some income. But we're going to focus on how to reduce your taxes this year. If that's the name of the game, if that's the approach to take, what are our few ideas? The first one, guys, is one of those new laws. And this is the super catch-up contribution. Take advantage of this because now you have more opportunities to get dollars into tax shelters, reducing your tax. So, guys, what is that? How's it work?
Well, that is available to people ages 60 to 63. And if you're listening to this and you say, hey, I don't even have a 401k, I'm not doing anything with a 401k. If you know someone ages 60 to 63, I would at least tip them off and say, hey, did you know there's this great opportunity for you to put even more money into this 401k plan?
401k or 403b. Mm-hmm. So here's how it works. There's a contribution limit. What is it? A 402g limit, Kevin? If I'm being particular, and that's $23,500 this year. It went up $500.
That's right, and it has been going up every single year, which is why you want to get a jump on this.
Yeah.
Even if you're not turning age 60 or age 50. Because as they keep on increasing the limits, you want to make sure that you're on pace to max this thing out if that's your intention.
And that limit applies, no matter how old you are. But at age 50, the year you turn age 50, you can do an additional $7,500. That's a catch-up. And this new law starting this year is, that's still in place. But in the year you turn age 60, there's this super catch-up. Instead of $7,500, it's actually $11,250.
Of course it is.
Of course. And of course, that applies the year you turn age 60, 61, 62, and 63. But the year you turn age 64, can't do it. Because of course, right? No, that makes zero sense. So working with some folks at the end of the year where this applied, works for a large university, so 403B. And yeah, we want to take advantage. So we said, let's increase your contribution amount 2% to ensure that you get this super catch-up in. So actually a little bit more we need to explain and prepare you for on that. And then a few other ways to reduce your taxes in 2025. That and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show. There's right here on this channel, 10 a.m. Eastern time every Saturday morning, also on podcasts at the same time, but also on a couple local radio stations, which is why the content's broken up the way that it is. It is a talk show, so it's going to be longer. We're going to drift. We're going to, all that fun stuff. But if you're looking for something more direct and shorter or whatever, we've got Next Wise Step videos that air all throughout the work week right here on this channel, well over 1,000 videos. Chances are if there's a financial issue that you've got questions on or maybe that you're dealing with, we've created some content on it to help you think about it from a financial planning perspective. So make sure you hit that subscribe button. Turn on notifications so you're made aware every time we drop new content. And if you like the content, like the content. Thank you.
Good.
Okay, we need to talk about the flip side to catch-up contributions. I can take us there.
Do you want to say anything about the weird simple extra?
Oh, we can.
I mean, it seems like it would fit right here.
Yeah.
As long as we're talking. It doesn't, I think, okay, you can do 7,500, but for 4 years you can do, wouldn't you say 11,500? Like if you were a normal person, wouldn't you say, well, you can go from 75 to 11 or 75 to 11,500?
The rule is 150%. Like it gets even weirder.
Yeah.
Do you ready? It's 150% of the current catch-up or
10,000.
10 grand.
Whichever is the larger.
They put the rule in place with a floor well below the current calculation. Which means,
They were either anticipating that someday the contribution limits would go down, or the catch-up contributions would go down, or they didn't do the math right.
Which would be an act of Congress changing the tax laws, which would mean someone could change this law that they put in place.
Right.
That is as dumb as
And it
you
appears
could
as though
possibly be.
this next administration, instead of ruling by executive order, they're going to try to get things done legislatively. It'll be interesting to see.
Yeah, we'll see. All right, second segment. Let's do it. What are some things that you could be doing right now, right on the cusp of the new year to set yourself up to pay less taxes in 2025? How's that sound? Sounds great to me. We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Doing proactive tax planning. Sometimes, and like this is going to almost sound counterintuitive, but the goal of that is for you to pay the least amount of tax over your lifetime, if not multiple lifetimes. The goal of tax planning, pay the least amount of tax over your lifetime, if not multiple lifetimes. Now, I would also say avoid tax surprises, which we're going to talk about here in a second. So sometimes that means, let me invite some income into this year so it doesn't land in the future. Because I'm willing to pay some tax this year because I'm at lower rates or I think rates are going to go higher. We're focusing right now. Now, that may be true. Work with your CFP. But right now, what are some ways that you can reduce your tax bill if you're focused on reducing and paying less taxes this year? The super catch-up, if you qualify, age 60 to 63, if you're doing pre-tax contributions, it's a way to reduce your tax bill. Be aware. Some of you are already thinking this and maybe already said, oh, these guys don't know what they're talking about because of this other rule. And that is, in the same rule that introduced the super catch-up, they introduced a mandatory Roth catch-up contribution. But that was for 2024. They moved it, the start date, to 2026. But here's why I'd bring it up. Because it's based on your income in 2025. From that employer, if you are making over $145,000 this year, then just know in 2026, your catch-up contributions, normal catch-up, super catch-up, Kevin had a joke about mustard before the show. We're not going to talk about it here. It's really bad.
Mike, I'm listening, and I just want to take my headphones off.
I know, it's
and
insane.
walk out of the studio.
It's crazy. But here again, like that's why we were talking about the glut, the people that are CPAs and tax experts racing for retirement, and no one behind them because of these laws, these rules.
It's not. Well, you know, the other reason too is that everyone was directed to finance and investment banking as well. So
Right.
I mean, what used to be the degree, which was to be an accountant and get your CPA, is now going to finance.
I know,
But here's
'cause
the
we
point.
make it look so good. Like that.
Right.
Finance looks good on you, baby.
That 145,000, that first of all, that's per employer, right? So if you had one employer for half the year and then you started with a new employer and never reached 145 with either, but you exceeded that by a wide margin in total income, you could still have catch-up contributions happening the traditional approach.
Yep.
And you might say, well, why would they do something like that? And I'm at least thankful that they didn't rule out catch-up contributions for people over 145,000.
That would
because they
be-
could have played with rules like that,
Oh,
right?
yeah, that
you
would
only
be-
get to contribute extra if your income is in a lower bracket or whatever. But so you're still allowed to save more. You just don't get to have a tax deduction or write-off for those catch-up contributions if your income goes too high.
Starting next year in 2026, but it's based on your income from that employer in 2025. Other than that, it's super super easy. The other thing that's super easy that we'll tuck in here before we get to the next idea is if you're listening to this saying, I don't have a 401k, hang with us because you might, right? A lot of companies are moving to 401ks because they can contribute more and they've made things a little bit easier to administer. I mean, we are serving a lot of small businesses, helping them tremendously with their 401k and making it easier and reducing costs and enriching the plan, all that sort of stuff. But if you are saying, I don't have a 401k, I have a simple IRA, don't think that you've avoided the chaos and confusion. Your contribution limit, guys, I don't have the exact amount for 2025 right in front of me, but if your employer, if the business has less than 25 employees, disregard that number. You can do 110% of that number. So you can do 10% more for your normal contribution and 10% more for your catch-up contribution for your simple IRA. And if you say, my employer is a little bit more than 25 team members, but it's less than 50, well, you still have the ability to maybe contribute more only if they're doing contributions a certain way. It's super confusing. Work with your CFP on it.
Yeah, that's exactly right. The trend has been for these rules to get more complicated, not more simple. And so you just really have to be vigilant each year, and now's the time at the beginning of the year to just reacquaint yourself with what are my contribution limits, how do the rules work in my particular situation, and most importantly, how does it fit with my retirement plan, my overall financial plan? And just because we're talking about contribution limits, that's the IRS telling you how much you can contribute. But what about you? You specifically, what do you and your certified financial planners say you need to be contributing? That's the key.
Yep. So normally you get to the next year, you put the new calendar up. People don't really do that anymore. But your retirement contributions are sort of on ice. No, guys, it needs proactive thought and some intentionality as part of your comprehensive financial plan because this impacts present financial position, obviously, your tax picture, tax planning, your investment strategy, your retirement plan, your estate plan. I mean, touches almost every area of your financial life. Let's move on to the second one. Second way you can reduce your taxes in 2025, if you qualify, is to donate to a qualified charitable distribution. We bring this up almost every time when we're talking about tax planning because it truly is that big of a deal, and a lot of people could be using it but aren't because the eligibility, you need to be age 70 and a half. That's it. Mm-hmm. And if you're age 70 and a half, my guess is you've got some habits built up with your giving that might be confusing or frustrating to change. However, doing so would mean and could mean some pretty big tax benefits.
That's exactly right. A lot of people, especially when they, as you said, reach age 70 and a half, they've been in a mode of giving, a pattern of giving for a long, long time, potentially. Maybe at the start of every month of December, I send out certain checks to certain charities. Maybe it's a weekly contribution as you attend a local church and you're a part of that congregation and you give tithes and offerings, and it's just a regular recurring pattern in your life. And so you might enter into a new year just doing the same thing you always have, not realizing that when you reach age 70 and a half, the strategy should change. If you have IRA dollars that you could contribute directly to that church, instead of doing it on a weekly basis or a monthly basis, what if you did it in more of a lump sum approach, and you could completely avoid counting any of those IRA distributions as income to yourself? You still save money in taxes by contributing to a charity, but you're saving it as efficiently as possible. We've talked about this an awful lot. But now's the time of year to start pivoting and changing the pattern is the big thing.
So often we bring it up at the end of the year as a tax planning strategy because it's a great strategy at the end of the year. But a lot of times people say, oh, well, I've been giving to the church every week throughout the entire year, so maybe we'll consider it next year. And then they don't.
Yeah, and I think the big deal is if I do giving to the church, if I take money out of my IRA and put it in my checking account and then write a check to the church, yes, if I itemize, which fewer and fewer people are itemizing these days, but if I itemize, I'm saving federal taxes, but I'm not saving state taxes.
Mm-hmm.
So the big deal is the state tax savings. So I'm not paying federal or state taxes going. So I didn't pay federal or state taxes on the money that went in, and I don't pay it on the money coming out. And the big deal is, I know I'm racing here.
No, that's good.
No,
you're fine.
But the big deal is if you might say, hey, I go to a small church, I can't bunch it up, I can't lump it up, I can't whatever. You can work with your certified financial planner. They can work with the custodian. You likely can give that money weekly if you need to. If you give $250 a week, you probably can send $250 a week right out of your IRA right to the bank.
Or you can even warn the church that, hey, I'm planning on doing a similar amount of giving throughout this year. I've done my planning and everything. I'm just going to give it in a different format, and you're going to get it earlier this year. We're going to do it in a chunk or periodically. And as Kevin said, there may be ways logistically to still keep the pattern going. It's just that it's not coming from your IRA to your checking account and then giving on a weekly basis. You're going straight from the IRA to the charity. That's the key.
Kevin said the big idea and the big deal is saving federal and state taxes, but it also, like, the big deal could be saving Social Security taxes,
right,
or taxes on your Social Security, right? Because there's a calculation done as to how much of your Social Security lands as taxable on your return, and this maneuver, qualified charitable distribution, actually is favorable to that calculation and can help that. So, guys, that's just two of the ways you can pay less taxes in 2025. We've got more coming up on the Wise Money Show with Korhorn Financial Group. Oh man, this is fun. This is good. By the way,
yeah.
So this extra credit here. Our team might cringe a little bit at the we can do it weekly because, and here's why. This isn't because, we want to make things difficult. We actually have had it where people switch churches and then they don't tell us. And then a year goes by and they're still
on
donating
autopilot
to the. So that's where anytime you are having money sent to someone else or a different organization directly out of your IRA on an automatic basis, you just need to remember that. So that if things change, things can change.
Yeah. Well, and the other tricky thing is can you imagine there's maybe more than one St. Mark church, and
or more than one Bethel University?
Right.
That's happened. There's 3 of them actually.
Right.
And every once in a while, a check will show up.
So there's one in Mishawaka. There's one in Minneapolis, and one.
Like St. Louis or I don't know where.
There's only one Korhorn Financial Group. So we got that going
that
for
you
us.
know of.
4 locations
to convenently serve you.
What's Caleb doing out in California again?
Yeah. Right. All right. Third segment.
Killing the bad guys.
Plenty of time. So All right. Here we go. What's your tax shelter strategy? Okay, how are you saving up to optimize and maximize your tax shelters? But if you're saving up outside of those tax shelters as well, is there a way you can do so to actually pay less taxes? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Go check it out. Go to wherever you listen to podcasts and search the Wise Money Show. Subscribe to it there. Rate the program there as well. We appreciate it. And you can listen to every episode, all the past ones, all the future ones upcoming as well on podcast. Talking today about things that you can put in place right now at the beginning of the year, help you reduce your taxes in 2025. Oftentimes we are talking tax planning throughout the year, yep, and at the end of the year, yep, and even this little window before April 15, yep, you can do some things then. But right now you've got a lot of direction on your cash in cash flow through, since we're at the perch, like they're right at the beginning of the year. And is there something you can do, tweak, adjust intentionally to improve your tax picture? This one is both a suggestion and a warning. So,
Wow.
Tax shelter strategy, oftentimes when you're looking at saving up for retirement, saving up for the future, you're looking at how can I do so in a tax-advantaged way? And it's very, very critical. And ideally, you're maxing it out. We see new folks come in all the time where they're putting money in a joint account, but they're not funding a Roth IRA. And those of you listening might say, blasphemy, never happened. Happens. And either because didn't know I could do a Roth, or I started this a long time ago, or whatever. So you want to maximize your tax shelters first. But outside of that, if you've got additional dollars that you want to contribute, maybe that aren't even earmarked for retirement, could be, but maybe you want to use them earlier. Maybe you received an inheritance and you have some resources that way. Maybe you sold a property or a business and have some resources that way. Your investments outside of your tax shelter, how you invest them can significantly influence how much tax you pay.
Mm-hmm. That's exactly right. And, some of this is tied to, well, what is the purpose of that money outside of a retirement account? If it's a really short-term purpose where you're going to be using some of these funds to buy a car in a year or something, then we would counsel you to not put that money at risk in long-term investments like the stock market, where they will fluctuate. Maybe you could have a really great year and get a nice little pop in that account. Or then again, maybe it could fluctuate in the wrong direction, and just at the time you're ready to go shopping for the car, those investments are not, they're not selling at an appropriate or a high level. So things like CDs in the bank or just money market holdings, those kick off interest to you, and you pay tax on that interest. You have to count it on your tax return each year. But what about longer term assets that are more growth type investments? Things that you're hoping will compound over time and just appreciate in value. Think things tied to the stock market or real estate, that sort of thing. If you're buying mutual funds outside of your retirement account, those mutual funds, it's a fantastic way to get diversification, but it could be exposing you to some unforeseeable tax ramifications, because you don't know what's really happening under the hood with those mutual funds at all times. The professional money manager that you've entrusted that money to, they are buying and selling stocks or bonds or other investments, and when they sell things at a profit, it creates a capital gain. Think of it as a growth or an appreciation that someone's going to pay tax on, and they're going to push that through to you. You'll be the one who counts that on your tax return potentially. But they don't give you any foreknowledge that they're selling some Microsoft stock that they've held for 2 decades, right? They don't tell you ahead of time that or warn you that there's going to be these capital gains because of activity happening. And so you could be exposed to some tax ramifications that you don't really see coming, just because of the good stuff that's happening inside that mutual fund.
Yeah, these capital gain distributions, just to reiterate what Josh said, you don't know them. You can't anticipate them. You don't get a choice or a vote. I mean, technically, you have a vote of ownership or a kind of direction of the fund, but but you don't get a choice on should we sell that Microsoft stock or whatever. And so you get your tax form potentially right now. You're getting your tax form from that non-IRA and seeing something called capital gain distribution. And that's right. The mutual fund doesn't pay tax on those capital gains. They pass that through to the shareholders, and all of a sudden you could be hit with a really big tax surprise. Is there a way to avoid that? Well, yeah, that's one of the benefits of using tax shelters. But the other is, instead of investing in a mutual fund, using an exchange-traded fund. An exchange-traded fund is going to look and feel a lot like a mutual fund. However, it has a special tax structure where, yes, they can pass through capital gain distributions. Most of them do not. They kind of work the laws that are available only to ETFs and structure it so that no, there's no pass through capital gain. So you're still invested in the markets. Maybe have a slightly different strategy than that active mutual fund you considered, but there's no capital gain distribution. So consider that. I mean, significantly. If you already own active mutual funds, you're like, okay, guys, what you're saying is barely making sense, but it has applied to me. I have felt this. Work with your CFP. I wouldn't just rush out and say, okay, I'm going to sell this mutual fund and buy an ETF, because then you might not just have capital gain distributions. You might have a realized capital gain because you bought it at a low level and now you're selling it at a high level, and that can be a double whammy.
Mm-hmm. That's exactly right. It potentially puts more income on your tax return, which can have ramifications elsewhere. If it pushes your income too high and makes you no longer eligible for certain tax credits or other tax deductions, it could push your income so high if you're over age 65 and all of a sudden you're paying more in Medicare Part B or Part D premiums. All that because you had these investments outside of tax shelters. You took some action without kind of measuring the consequences. And so, again, it's not too early in the year to be thinking about 2025 and even having a conversation with your certified financial planner about what's our strategy going to be this year for liquidating certain investments, getting our hands on some cash for the needs that we have in the year to come.
You might be listening to this and saying, well, I'm using index funds, so I don't have a lot of this. And you don't. The index funds, they're actually wanting to retain your assets, and so they're really working hard to not pass through capital gain distributions. But even in my own situation recently, I just said, nah, I'm going to move these to ETFs just because, so that I don't have that risk, and work with your CFP. See if that makes sense for you. Okay, fourth idea for you to pay less taxes in 2025, the donor advised fund. So we're going back to your giving strategy. Kevin, what's a donor advised fund? How's it work?
A donor advised fund is an excellent tool to optimize your charitable giving. And the way that it works is that you put money into a donor advised fund. But it's not just money. You could put cash into a donor advised fund. You could put highly appreciated securities into a donor advised fund. You could put a house into a donor advised fund. So there's all kinds of creativity, but basically you're doing a charitable contribution into the donor advised fund. And typically what the way that it works is throughout the year you're giving money here, giving money there, but you're giving it out of your checkbook. But with a donor advised fund, you put the money in, and then as you make a grant recommendation, they approve the grant, and it goes to the charity. So the beauty of doing this is, especially if you have lumpy income, you have a high income year for some reason, you want to look and optimize and say, how much, if I'm giving to charity, would I want to give to charity? And then you can put it in the donor advised fund. The charitable deduction comes immediately. So if on whatever day, that's when I get the deduction. Now, and you say, well, why might that matter? Well, it might matter because I might not itemize every year. So if I'm putting a bunch of money in, I could even be putting years worth of contributions in, because if I give $25,000 a year to my church, that's over the next 4 years, that's $100,000. Well, if I had $100,000 sitting here today and I put it in my donor advised fund, I'm for sure itemizing, getting the financial benefit of giving that money, and then I can set up an auto distribution right out of my donor advised fund right to the church and send that money.
So cash flow and operationally to the church, easy peasy,
Well,
and tax deduction for you, even better. And so work with your certified financial planner on whether the donor advised fund is something you should consider, and optimize, stack those contributions. We got more coming up on the Wise Money Show with Korhorn Financial Group.
I
seemed like you wanted to keep going. And I'm
I
like,
did. No, I did. I know. Well, so.
No, we can pick it back up.
No, once the show, Mike gives me the finger. Okay, all right. Okay, Mikey Paul. So, but I think the big deal really is to the church because, yesterday we were celebrating, hey, we helped this church set up a brokerage account. And then we helped this person move money, stocks from their brokerage account to the church. And did you see me crying? There were actually tears coming down my face, and they were not tears of joy, because
Could have been a donor advised fund and send cash to the church, you're saying?
Yes. Yeah. Do you know the administrative burden that's involved? Do you know the churches that we've worked with that had an old brokerage account with some stock still in it that never got sold? And the other thing is, okay, the church has to send a letter saying, hey, Mike, you donated 100 shares of Apple on this day. The trading range was here. On this day, we sold it at here. Take this to your tax advisor and figure out how you're going to use it. No way.
It's needed, yeah.
But then the other thing the church has to do is, and the reason why the donor advised fund is, we're talking about, all right, at the beginning of the year, organize your stuff. With a donor advised fund, there's no stuff to organize.
Yes.
I'm not waiting for 15 different charitable letters saying this past year you gave X to this charity.
That's right.
It all went into the donor advised fund.
Mm-hmm. Yep.
So
All right.
that's where, if you looked at an operating system for your financial life,
Let's share. I mean, it's 4-segment land on the plane, but let's share that, and then
trying to keep
we
it a
can
secret.
get into the retirement savers credit. So, all right, here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode, as well as a lot of other content, is on the Wise Money YouTube channel. Go to YouTube, check it out, search the Wise Money Show, subscribe to it there. Turn on notifications so you're made aware every time we drop new content, because not only is every talk show there, but all throughout the work week, we've got Next Wise Step videos that air every single business day. And so there's well over 1,000 videos, lots of subscribers. Go be one of them. Go to YouTube, search the Wise Money Show, subscribe to it there. All right. Talking about ways that you can save on taxes in 2025. Sounds like a great deal. The donor advised fund we left off on, and then Kevin went on a rant during the break. So another reason to go to the YouTube channel in a good way. I mean, the donor advised fund is an operating system for your giving.
yes.
And it simplifies things for the end charity. It simplifies things for you. And it doesn't mean it's only appropriate for those of you that happen to have $100,000 sitting around that you can throw into this thing. It could be something that you want to have set up. So then when an opportunity comes up for you to say, oh yeah, the market had a really good year, instead of donating cash at the end of the year, I want to donate this stock because it really appreciated. So now you have the operating system set up, and you can do that really efficiently. The church or the charity really likes it because it's much easier on them. Kevin shared all the ways that it's easier on them, and it's easier on you as well.
Right. And so the other one of the other benefits I like about a donor advised fund is, it used to be, if I was going to give stock to a church, there would have to the shares would have to go from my brokerage account to the church's brokerage account. Well, one of the things, if the idea is to not let the left hand know what the right hand is doing as it relates to your charitable giving, there's no way. Everyone and their brother is going to know, because of the administrative burden of that happening. Versus if you had a donor advised fund, you just move from your brokerage account And so we custody at Fidelity. So you move those 100 shares of Apple from your donor advised fund, from your brokerage account to your donor advised fund. You sell them. You got the charitable benefit when they went in, and then you can push that money out to the various charities when you want. But the best thing is if you had a windfall, you pretend you go to a small church and you had an inheritance that no one knows about and you don't want anyone to know about. And you said, well, I want to give money to the church, but I don't want to be waiting for a giving receipt after the beginning of the year saying, hey, you gave X to the church, and you don't know whose eyes are on that gift. You have perfect privacy. And really, if your church accepts donor advised funds, I would encourage you to have them set it up to receive an EFT, so the money can go directly into the church's bank account, and there aren't people in the administrative office who have to open envelopes and do these various things. There can be a little confusing because if you make it totally anonymous and it's for a specific pledge fulfillment, it can be a little confusing. Or if your church is doing a building campaign, there's likely only one account that receives funds. But
Got it. Well, donor advised fund, big opportunity there. I get teased here on the show from Josh and Kevin about loving the Roth. They even say it's my nickname. Kevin, you might have just earned
That's right.
a middle name. You might even like Daft Man, like the
Dude,
Simpsons reference. I think you just got another middle name there. So I love it. I love the passion. It's a huge opportunity, and the reason we'll talk about it at the end of the year. If you have end-of-the-year resources or doing some end-of-the-year tax planning, but at the beginning of the year, you've got opportunity to direct cash flow and resources each month in each paycheck. And consider setting up that donor advised fund and getting going on this so it's not something you need to react to and hustle up to do at the end of the year. All right, last one we're going to hit. There's lots of ways that you can reduce your tax bill, but last one we're going to hit today is find a way, if you're close, find a way to qualify for the Retirement Savers tax credit. It's our favorite tax credit. Josh, Go ahead.
Well, we love it so much because it's an incentive to do something that you really should be doing anyway, right? You know that you need to be saving for the long term, that someday there will come a point where you're not working and you need to have resources to be able to live off of. So saving up for retirement is an important, steady progress that you need to be making throughout your entire working career. And this Retirement Savers Credit is essentially the government participating in your saving for retirement in a way. If you qualify, if your income is low enough and you contribute to a traditional IRA, a Roth IRA, really any qualified retirement plan, it's the first $2,000 per spouse that can count towards this. But the government will just knock some dollars right off your tax bill. That's what we love about tax credits, is after you've already calculated your taxes, then tax credits apply. They start eliminating actual tax dollars off of the return. So tax credits should always make your ears perk up, especially if you're on the verge of being eligible for some of these. If you are a married couple and your adjusted gross income is $76,500 or less, then there's some amount of this credit that you could be eligible for. And it just depends. There's actually 3 different tiers. You could either get a 10% credit, a 20% credit, or as much as a 50% credit. But unfortunately, if you're even just a little bit out of the range, you get none.
Yeah.
And so this is why you'd want to pay attention to this early in the year, because what if you've been getting the Savers Credit for a couple years in a row now, but your income keeps creeping higher? And maybe you've been listening to this show and you know that we would favor the Roth contribution if you're in a lower tax bracket. Well, you may want to switch to a traditional contribution to help keep your income low, keep yourself in the range longer, right? Mm-hmm. But that only helps you if what you're contributing to is a 401k and it's coming out of your paycheck every pay period. That's something that you need to know ahead of time. Make your adjustment to whether you're doing Roth or traditional contributions to that account do it early enough in the year that you can actually have an impact on that adjusted gross income. So the thing we love about this credit is, yes, as you're contributing, if you play your cards right, your contributions themselves could make you eligible for the credit if you were just a little bit out of range.
Yep. So yeah, this doesn't apply to everyone, but by golly, if you're close, I think if you're starting your career, maybe you're in grad school, maybe you are working but also taking classes, maybe you're at the end of your career, these are all times that just sneak up on you, where all of a sudden you could find your income in these ranges while still contributing. And you might, without thinking, oh, I got to do Roth. Now, Roth contributions, you get these credits. That's great. But your Roth contribution doesn't reduce your adjusted gross income to ensure that you're eligible.
Right. And the only thing is you can't be a full-time student, and you
right.
can't be claimed as a dependent on someone else's return.
Yeah.
And for 2025, the adjusted gross income limit is $79,000. So
Yeah,
it's
good
even
point. It's
bigger.
gone up. That's right.
Yeah. Now, the other
Inflation.
thing to be aware of with this is the retirement savers tax credit. Guys, we're running out of time, but I do want your opinion on this. We're going to talk about it more. But they're changing it. That's changing in 2027. It's a couple of years from now. I don't think they're going to do it. I think it's impossible, personally. But they're changing it so that instead of this tax credit boosting your tax refund, the tax credit's going to go directly into your retirement account. What's your take on that? Now, that's not happening this year. It's going to happen in 2027. Guys, like it?
Logistically, it seems very easy to pull off.
The government's going to drop money into your account for you. It doesn't.
Right.
It doesn't make any sense.
And remember, it's not a refundable credit, so it only will wipe out your tax liability. But I think that's I don't know. I feel like that's a terrible idea.
I do too.
Because the government only can put money into your IRA that they've garnished out of my paycheck.
That they have access to. I know. It's like I don't like it. Now, you'll have a little bit more in your retirement account. It will grow tax sheltered. I mean, there's a few. If you, I don't know, altruistic, you might say, oh yeah, these are some great things. But just the mechanics of it, nope. I just don't like it. I think it's probably
overreach.
It's impossible that they're even going to be able to pull it off. And the overreach, the access scares me. But we got a couple more years to be afraid of that before it actually even happens. So all of these ideas and these changes even that we're talking about, hopefully it urges you and shows you the necessity of doing proactive tax planning with your CFP as part of your comprehensive financial plan. So work with your CFP on that. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.